Alright guys, many of you have asked about the valuation of Relaxo. There are a lot of comments saying that Relaxo has P100. It is very overvalued. What is the reason for adding Relaxo in our portfolio? In this video, we will check what we see typically and what we miss. When we check the valuation of Nifty 50, we see P value varies from 15 to 35. If we see a stock having higher P than this range, we think the stock is overvalued. In this video, we will take a stock from Nifty 50 and compare its financials with Relaxo. As you probably know, Reliance Industries has double-digit weightage in Nifty 50. So we will take Reliance as an example to check market valuation and then compare it with Relaxo. By the way, we have Relaxo in our portfolio, so we could be biased towards our outlook. As you know, never ask a bartender if you need a refill. So do not consider any of this content as a financial advice. Without wasting any time, let us directly dive in. So let us try to understand what people see at the first glance. Relaxo, P100, Reliance, 36p. And they said that, oh shoot, Relaxo is super expensive. They would say, no matter how good the company is, there must be a maximum limit for P. 100p is too much. And the gossip continues, you know that. This is how our brain works. We do not know whether Relaxo is cheap or expensive, so our brain cannot answer this question. Instead, our brain tries to find answers for a relatively easier question. Whether P is high or not, this is a relatively easy question. Obviously, in this comparison, Relaxo is much expensive. So now let us focus what our brain do not see. We will look at some facts and figures. I'll walk you through these numbers one by one. Nothing to worry, these are very simple calculation to understand. To make it easy, we will take an example of real life, okay? Say we get a new job offer, and with that new job, the company offers a CTC, right? This CTC amount we will get if we do the job. If we take this concept in investing, this CTC is earning or profit after tax. In short, it is PAT. For Relaxo, you see PAT here for last 10 years. 2012, 40 crores. 2013, 45 crores, like this. In 2021, the PAT or earning 292 crores. Those who are salaried person, you know that CTC of your job offer and the money you finally get, both are not same, right? So the money which gets credited in our bank account at the end of the month is operating cash flow. Means the cash that you are finally getting. It really doesn't matter how much CTC any job offers. What finally matters is how much money gets credited to your bank account, and this amount is termed as operating cash flow. If we take this simple concept in investing, operating cash flow for a company means how much money ultimately the company gets by selling its product. Here, please remember, earning or PAT is a promised number, just like your CTC. Finally, what you get is your operating cash flow. Whatever amount of money that you get, it is your operating cash flow. It is a very important number because you are finally dealing with this money. For Relaxo, you can see in 2012, your operating cash flow, it is 73 crores. It is a bit higher than the earning. And in 2013, it is 54 crores. Again, operating cash flow in 2013 for Relaxo is higher than its earning. Out of 10 years, 8 times. Yes, out of 10 years, 8 times Relaxo had operating cash flow. It is higher than its earning. Very simple to understand, right? Now, the money you get in your bank account is not your complete saving, right? Because you spend money for your lifestyle maintenance and you invest for your productive work, right? So this money would be gone from your bank account, right? In your personal finance, it is called expenditure or expenses. In company's accounting, it is called capital expenditure, or in short, it is called capex. From your operating cash flow, you will make this expenditure, right? I mean, if you can make your full expenditure using your operating cash flow, it is very good, right? Because otherwise you have to take loan to keep up your expenditure. So it is very important that you make expenditure less than your operating cash flow. If you see the capex of Relaxo, it is mostly lower than its operating cash flow. That means to maintain and upgrade business of Relaxo, it did not have to take loan. It could manage all of its expenses using the operating cash flow. For example, 2012 operating cash flow of Relaxo was 73 crores and its capex was 49 crores. Means less than its operating cash flow, right? Next year, 2013, its operating cash flow was 84 crores and capex was 84 crores. Means in 2013, Relaxo needed extra fund for capex. Out of 10, 8 years, capex was lower than its operating cash flow, which is really superb. If you want to see the picture in 10 years, you can take summation of operating cash flow in all 10 years. It is 1808 crores. If you do the same for the capex, you will find 1000 crores capex. That means in last 10 years, Relaxo has got enough money to keep its maintenance and upgradation without borrowing any external fund. After all the expenses, whatever left in your bank account is free cash flow. Simply put, operating cash flow minus capex is your free cash flow. It is a very good sign to save money every month, every year. It helps you to grow rich eventually, right? Let us look at the free cash flow of Relaxo. In 2012, it has got operating cash flow of 73 crores, and from this 73 crores of operating cash flow, they have invested 49 crores for maintenance and upgradation, which is capex. After doing capex, they had 24 crores left in their account. So in 2012, they had free cash flow of 24 crores. Going forward today, their free cash flow increased to 394 crores. So you can understand their free cash flow increased 9 times in 10 years. All of you know what is ROCE, right? It is the return on capital employed. Simply put, how much return you generate for every 100 rupees of capital investment. So for every 100 rupees Relaxo is investing, they are getting 21 rupees in 2012, 19 rupees in 2013 likewise. And every year their capital base increases because they're doing capex. And the incremental money which is getting invested every year is also growing at a rapid pace. Let us simplify this. Initial year, you started with 100 rupees. Next year, you made 20 rupees profit. Means your ROCE is 20%. In this 20 rupees, say you invest 50% of that. That means 10 rupees out of 20, you reinvest in the business. So your capital base in this year is 100 rupees of previous year plus additional 10 rupees. In total, your capital invested is 110 rupees. And in this year also, if you are getting 20% return on 110 rupees, that means you are earning 22 rupees. Last year, remember, you got 20 rupees as profit. And this year, because of your reinvestment of 10 rupees, you have got 22 rupees. Means 2 rupees of additional profit you made. Any additional capital, if you are investing at a higher rate, it is going to give you more and more profit every year. Now, Relaxo didn't have to borrow any money. All the money it has acquired as a profit, a portion of that it has reinvested in the business. The return you generate on every additional investment, it is called return on incremental invested capital. In short, it is ROIC. When there is a capex, it's very, very crucial that we measure what is ROIC. If you see, Relaxo is getting very high ROIC, which is really good. First, you are getting 20% return on capital that you have invested. Then the return that you are generating, you are investing a portion of that at a very high ROIC. If you let the system run, it is a compounding machine. The more time you give, the more you will see the power of compounding. So time is a very good friend of this business. Now let us come to PE. Price is the total market cap and E is the earning or PAT. If you calculate this ratio, you get PE equal to 100. Very high number, right? As you know, earning is a promised number. You rarely get the money what is promised. So let us see how much is the price with respect to the free cash flow. Last year, free cash flow of Relaxo was 390 crores and its market cap was 30,000 crores when we are recording this video. So price by free cash flow is 76. Let us see this number for Reliance. We already know the P of Reliance is 36. What about price to free cash flow ratio? Let us try to calculate. Now for Reliance, we will not go through the details of it. Since you already understand the significance of those numbers, it is easy for you to understand the table which you can read by yourself. So let us come to the summary of it. Out of 10, 7 years capex of Reliance exceeded its operating cash flow. That means their free cash flow was negative 7 years out of 10. Free cash flow negative means what? That means they have to borrow money to maintain and upgrade their business, right? If we take summation of operating cash flow for Reliance in last 10 years and capex for last 10 years, we see how much fund they have borrowed. By the way, external fund is not free. You have to pay interest on external fund, right? Better you earn higher rate of return than the cost of borrowing, right? Let us put it in simple words. If you are borrowing the money from bank at 10%, you better earn more than 10% to make any profit, right? If not, then why would you borrow the money? Doesn't make sense, right? So taking this example, you can understand that the return on incremental invested capital must be higher than the cost of capital to make the real profit. By the way, in India, you need to pay interest of at least 8 to 10% from bank. Now, this is the case when you are borrowing, right? Because your capex is funded by external source. This is the case for Reliance. Now, let us look at the return on incremental invested capital. If you check, it is in the range of 0 to 10%. In 2017, their ROIC was 0. That means you were paying 8 to 10% of interest every year to the bank, and with that money, you are making 0% of return. What does that mean? Well, you know it better than me. Now, you have to see the other side also. How much return on capital they are earning means what is ROCE of the business. That means for every 100 rupees of employed capital in the business, how much of return Reliance is making. In 2012, Reliance made 11%. In 2013, it is 10%. If we see over 10 years, ROCE is in the range of 8 to 11%. So if we try to calculate the free cash flow of Reliance and compare it with the market cap, we cannot do because it doesn't have any free cash flow. The capex that it needs, it is much more than its operating cash flow. Because of that, there is no free cash flow. Free cash flow is negative. If we compare price to free cash flow of Relaxo, which is 76 times, certainly it is costly. But it is a compounding machine we have seen. On the other side, we cannot even calculate the price to free cash flow of Reliance. It is super expensive at this point. Now, why it is not fair to compare PE? Because E here is the earning, and earning is always promised. It is not the real money that you get in your account. Now, all those things that we are talking about past data. Investing is all about free cash flow in future, right? We really do not know if Reliance can earn higher ROCE or higher ROIC. We have to wait and see how much free cash flow Reliance generates. If it generates enough free cash flow in future, we will be able to calculate its price to free cash flow ratio. And only then we will be able to compare these two companies. Till that date, we will consider Reliance Industries is super expensive at this price point. Thank you for checking out this video. There are a lot of interesting discussion happening in our Telegram group. Mostly our channel members are very well-informed investor. Discussion is much more fun in that channel. If you are interested, do join in the channel. Thanks once again for your growing support. We'll catch you up in our next video. Until then, take care. Bye.